Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorten. I'm here always with Paul. And Paul, we're going to really do a continuation, aka part two, of our gold and silver update. Now, one of the more important things that people have been latching on to, and we're going to talk about and discuss why this is absolutely incorrect in the majority of cases. Obviously, the uh, mainstream media came out with a report. Gold hits record high on safe haven demand amid tariff threats. And they are trying to tie the tariff threats to what is going on with the sudden rise in gold and silver, not, of course, taking into consideration that gold and silver have been rising for pretty much at the end of the coming out of the pandemic. But with this being said, it seems like it's either being used as an obfuscation that this is really just a temporary thing of why gold and silver are going up and we should ignore it, or it's a matter of that most economists in the mainstream have no real idea why gold and silver is functioning in the capacity it is, as well as its relation to the dollar interest rates and the like. Paul, as always, want to thank you for being a part of this discussion. And what's your thoughts on regarding this?
Oh, well, thanks also again for joining today, Ken. Yeah, look, the issue with the tariffs is, I mean, I don't doubt there are people who believe it to be genuinely true because they think it's an obvious explanation. I'm not in that camp. I'm not saying anyone's deliberately misleading people either, because I don't think that's the case. But I think there's this assumption that because there was this concern that Trump would put uh, tariffs on gold and silver, maybe 25%, whatever, then that's obviously going to this is gold and silver obviously being imported into the United States, that this was going to cause problems at the Comex because so therefore everyone's rushing to buy as much physical gold as they can uh, in the Comex. And you can understand why people possibly believe this, but I didn't see any evidence anywhere where Trump said this would happen. I mean, he talked a lot about tariffs, and we're going to do a whole segment on tariffs. We're not here to discuss tariffs specifically today. So, on that basis, I think you have to start looking, okay, what's actually going on? What have we seen happening? And how does this correlate to this idea that it could be related to tariffs, or is it related to something entirely different? And one thing we can start off with saying is if you look at gold exports to the US from Europe's main refining hub, which happens to be in Switzerland, that was the highest since Russia's invasion of Ukraine. Because there was this huge sort of need to obviously import gold bullion into the United States, on people saying on the basis of tariffs. Well, let's just park that thought. So in December, 64 tons of gold arrived in the US from Switzerland. That was the most since literally just weeks after the start of the Ukraine war. Excuse me, but to put that in context, that was 11 times more than in the month of November. So you have to sort of think, why suddenly this big increase? Now, if you look at gold prices in the COMEX compared to the gold price in London, the difference between futures and spot, there's no doubt the delta between the two was probably at times, excuse me, $50 an ounce, which is quite significant. So it does create an arbitrage opportunity as well, which may have accelerated some demand or for gold moving from London to New York. But bear in mind, someone has to want to buy it. I could sit there thinking, well, I've got an arbitrage opportunity, but I have to find a buyer who's willing to buy that gold. So again, that still implies physical gold demand. Just to put this in context, the delta between spot silver and future silver was like $1, $1.30, I think was the most I've seen recently, which again, you could argue creates a possible arbitrage opportunity. But the argument has been that for whatever reason, people were obviously trying to close out short positions. And this is another reason why metal was going hugely shifting from London to New York. But there's another point about the Switzerland angle worth mentioning, because gold exports to the UK also jumped more than 13 times to 14 tons in December from November. So clearly, because if there's this huge demand in the US, then you've got to replace that demand that's going from London to obviously New York by supplementing by a whole raft or whole large volume of gold heading to London, which is exactly what we saw, which is interesting because it implies as well the demand inside London was being maintained. So they couldn't just go, well, let's just ship a load of gold off to New York and we've managed the problem. And, and therefore it's gone away. It hasn't. It implies also, when we'll come on to this, why it seems as though there are shortages also both in London and in New York. And why I would make that point, one of the reasons is look at what's happening, not just the delta between spot and futures, but how the spot price in gold and silver is being driven up in recent time. That implies to me a shortage in both. The delta can stay the same, but if it was less of an issue in London, you wouldn't see the spot price moving the same.
One thing people don't really understand, and it's really one of those concepts like, where did this come out of? But going back to about 2018, the Comex and LBMAs created this sort of partnership, and they started as more and more people, or at least institutions, I should say, were demanding gold delivery. The Comex wasn't able to facilitate it. This was especially when there was something like 400 contracts for every ounce of gold that was in the eligible or registered portion of the Comex. But they created this scheme called exchange for physical, where a Comex contract would then be sent to London, which then they may or may not, more often than not they did, then would provide delivery of the gold. So the Comex was already showing signs of cracking back in 2018. And there was a article that came out, I think perhaps, I don't remember the publication, but the weight to withdraw bullion stored in the Bank of England's vaults has risen from a few days to now 4 to 8 weeks. And one of the primary things is, since the November election in the US, gold traders and financial institutions have moved nearly 400 metric tons into the Comex vaults. So that was back in November. And they were already starting to see cracks in London of delays for delivery. Then we have, of course, the announcements from the Comex, and you always take these with a grain of salt, because how much do they actually want to tell the truth of what's going on? But with that being said, because the commitment of traders report is no longer up to date and valid, so I just want to put that aside. There were 22,000 contracts that were issued for delivery in January. That's 2.2 million ounces. This month there was over 4,000. I'm talking 40,000 contracts, which means that 4 million ounces. So 6 million ounces have been automatically delivered from the Comex alone in the past 2 months. And that only appears to be accelerating. And if gold is having to be shipped since November from London to the Comex, how much longer until it breaks? That's really a serious question to ask.
Yeah, we don't know. It all depends on what can be delivered to both London and New York. But to put some context on this, you make the point, Ken, you used to be able to get delivery out of the Bank of England, which stores gold for central bank. It used to be 3 days. Now it's 4 to 8 weeks. Now, that is a heck of an increase, which implies stresses and strains, liquidity issues in the bank. And to put this in context, if you look at London bullion markets, they borrow gold, can do, from central banks, which obviously store bullion in London. And that's to try and handle this surge in gold deliveries to the United States. Whether it's people believe it's to do with tariffs or not doesn't really matter. The other point is worth noting, London is actually home to the world's largest over-the-counter gold trading hub. That's where market players trade directly with each other rather than via an exchange. It isn't an exchange in London, and it's an important point worth mentioning. But what's very clear, if you look at the free float in London, which is the amount of gold readily available to this London over-the-counter market, that's fallen because of this jump in supplies to New York. If you look in the last 2 months or so, there was 12 million ounces of gold were delivered to Comex approved warehouses. That raised stock levels by 70% to nearly 30 million ounces. That was the highest in 2.5 years. And so therefore you can see there is this enormous demand suddenly for delivery in New York. Now the question is, who are these parties? Why do they want delivery? This could be a combination of people selling out of short position. So there's an enormous desire to get out of short positions, but also people going, I just want physical delivery of my metal. And there's no doubt this huge surge in gold shipments to the US is going to cause this shortage of bullion in London because it's been enormous. And, because people in London can't get hold of the gold the same, because so much has gone to New York and everyone's stuck in this queue going, which is why they're having to take weeks to get their gold. So liquidity in London is clearly diminished. Another point worth making that's important about all these gold flows into the US, it could actually be a lot higher than Comex numbers because of not just these opaque markets, but there could also be additional shipments to private vaults in New York that can be owned by banks, bullion banks. Banks are not commenting on this, which might imply that that is indeed the case. But obviously the shipments also therefore result of the higher prices in the futures exchange in London than the cash market in inverted commas in London. So yes, there will be some arbitrage going on, which basically means traders send the metal across the Atlantic and profit accordingly. But you also have to factor in that and you make the point, Ken, when does it run out? We don't know. It could go on for a long time. It might not do. But the other issue is there's so much gold going to other markets like Shanghai and Dubai. It's not like they're just that London and New York are the only players in the market now. They're not. You can sit there and go, oh, there's all this physical trading going on in UK and futures trading in the US, but they don't dominate the markets anymore. And therefore, that is likely to be partially the reason why these stresses and strains are growing, because of this big shift and change in market dynamics, as we've said previously, between what you might term London, New York, Switzerland, to places like Dubai, Shanghai. Even the Russians getting involved in gold. You have India. You have, just countries everywhere now. Suddenly, even Saudi Arabia are setting up or want to set up a gold exchange. So that dynamic shifting, and therefore that's going to cause additional problems. And the question always comes back to this point: what is the difference between paper contracts and physical gold? And if for some reason, because people envisage a spike in the prices and want to get out, they get out of short positions, or people just want physical delivery, then where the strain becomes intolerable, between the paper and physical markets, that's when things break. And there is some evidence to suggest that, as we've discussed. If you look at the premiums also between spot gold, futures gold, spot silver, futures silver, the amount of gold that has been shipped in terms of the gold inventories and the Comex. We've seen the highest monthly flows recently since May 2020 during the pandemic. I mean, because they need access to gold to fulfill futures contracts, which therefore obviously allows the buyer to take physical delivery. So these are important factors. This is factual information. It doesn't mean it's the end of the line, and people should be very careful in listening to anyone who suggests that. But if this continues, and there's a bit more I'll come on to in a minute, Ken, so you can obviously come in terms of the data which supports this viewpoint that it's not something that's sustainable forever and a day.
Yeah, you touched on something I was going to bring up in my next commentary here. We've talked about in the past how there has been an arbitrage between the Shanghai Gold Exchange and London, the West Switzerland, etc. And you can see this in the price differential in their respective markets. And it's kind of interesting, of course, because while the Shanghai Gold Exchange has a futures market, they are specifically built for physical delivery. For all intents and purposes, they're a cash market that masquerades as a futures contract market. In the West, of course, we are primarily a futures market that masquerades as a gold delivery mechanism. Well, ironically, what has happened since the election has been a price arbitrage transatlantically. The cash market of London has seen higher prices in the futures market and spot markets of the West of the US, and thus we have an arbitrage of massive proportions going from London to the US. So it's kind of funny that for probably since 2012 or so, we've seen that arbitrage occur from west to east. Now we're seeing we're in amongst the West at the same time when you have many of the BRICS nations, the ASEAN, the SCO, etc. A lot of these different central banks are themselves in Eurasia and Asia continuing to buy at large amounts while it's being focused. The focus is happening in the West. So I thought that was kind of interesting. And the other important point that needs to be done is what is really this big rush for demand all about? I honestly think that more and more countries, not just from the fear and threats of Trump with his tariff policies or trade war policies, but I think the world really is at that shift that they are moving away and want to move away from the dollar. And the true capacity to be able to do that is either through cryptocurrencies, which are so new that really a lot of individuals and platforms don't really know how to utilize that in that way, the same way that AI is so new to the scene. But gold and silver have been around, and they've been the primary function, the primary platform that central banks and nations have used to be able to divest themselves out of foreign currencies into something that's more stable and recognized as we go. So despite the fact that Trump wants to make, as he said, everybody use the dollar again, the fact of the matter is that for the past several years, nations that have had dollars in reserves have been sending them back. That in part has been driving up the price slowly over time. And now the question is, if Trump is going to bring about this trade war mentality, this tariff mentality, do nations really want to hold dollars at all or in any real capacity? And instead, they're going to go ahead and try to get as much gold as they can and divest themselves of the dollars because they're not buying treasuries.
Yeah, exactly. And here's an interesting point to make. But first, I'll make this point. Everything we've discussed about gold today applies to silver also. Just the data's not as freely available, but there's no doubt the same problems are happening, whether it's the gold or the silver. In fact, the delta between spot silver and future silver is in percentage terms much higher, which implies even larger stresses in the physical silver markets in the West. But just to put this in context, we mentioned the issue of 12 million ounces of gold over 2 months being withdrawn from London. London has approximately 280 million ounces. That's what we're told. So we'll work on that basis. So in percentage terms, it's not even 5%. Now, why would that with amount withdrawal cause stresses in the market in London? Bearing in mind, because of course, it used to be 3 days for physical delivery after demand. Now it's 4 to 8 weeks. There's clearly liquidity issues. And this comes back to just because there's 280 million doesn't mean that anyone has access and can just utilize that gold. If that gold's accounted for, the gold's accounted for, then you can't just simply go, well, I'll just take all that gold and ship it off to the US. So it's what is actually available. So this is the dynamic between supply and the demand. So is this problem, could we say, due to outstanding paper in London compared to the gold that's vaulted? We don't know what the ratio of paper to physical is. But the fact, as we say, that you've gone from 3 days to 4 to 8 weeks clearly says to me there is a lack of liquidity. And I think part of this is because if London sold gold spot contracts now, refineries are going to have to source gold from elsewhere and then refine the gold into what are termed London good delivery bars. Where are they going to get that from? Because they're now competing with the Chinese, the Indians, the Saudis, Dubai, etc. So we're kind of reaching a point almost where there's this kind of musical chairs approach for me of everyone across the globe is seeking gold. London needs liquidity. New York needs liquidity because London is having to feed New York. And how long can this go on? It can't go on forever. We don't know. I mean, suddenly we might see a drop off in the demand, and New York quietens down, and London quietens down. But we're seeing an indication, precisely when I made the point in 2013, that you will start to see price discovery when the West is effectively running out of gold and silver, and on a small scale, in a small window, in the last month or two, we are seeing that. But that has to become an established problem that isn't going to go away, and is just repeatedly a problem whereby markets have to change accordingly, where physical metal is in sufficient quantities to satisfy demand in both London and, of course, New York. Then you start to say, well, is the market then going to be purely physical? Then do we start to see true price discovery? And that's the whole point. So we're on the cusp of something. It's early days, so be very careful, as I say, making assumptions. Again, this is just for educational purposes. This is not investment advice. We are not saying what the gold and silver price will be in the future because we don't know, and it would be reckless for us to say so. But this is event driven, and the event driven scenario is something we haven't seen of this magnitude. I mean, we have seen some evidence of things in the past, but not the way this has been going on for basically 2.5 months now, or round about that. So these are on relatively uncharted waters. But as ever, be careful, because there'll be people out there who want to make you go buy loads of gold and silver on the basis of some promise that they can't fulfill, because that's their job to do that. They want you to buy metal on that basis. So, if you want investment advice, go and talk to someone about this, and because we're not here to provide that, because we can't provide that. But we'll keep a check on what's going on, understand the dynamics of what is unfolding, but everything we've stated is factually correct. And it does support the viewpoint that there are stresses and strain that are ongoing in gold and silver markets, both here in London, both in London, and New York. And it remains to be seen if that is the case. But if it continues, then we'll start to see the price trajectory following what it has done to all intents and purposes since Trump's election. And we'll track that accordingly, because it's hugely interesting to understand this dynamic, and it will have far-reaching ramification if it eventually plays out irrefutably how we've seen it playing out in the last couple of months.
Absolutely. And I think the final point I'm going to make is throughout history, tariffs have not been used when it comes to gold, silver, or major commodities. Sanctions have been the stick of choice that the U.S., Europe, or other nations have used. I recall back in the 1980s, they wanted to stop Americans from buying Krugerrands, so they sanctioned South Africa under the spurious guise of apartheid so that they couldn't export those. Then, of course, we have what they're trying to do with Iran and Russia regarding oil. They're going to put sanctions. They want to drive the price down to the ground for them and them alone. So you're not going to really see tariffs being used as a whole when it comes to gold and silver ever, and mostly oil. It's usually the sanction stick that's being used, and it's something to take into consideration when more and more articles come out trying to equate the rise in the price of gold and silver to tariffs, rather than to really it's the world moving away from the dollar. Paul, as always, I want to thank you for being a part of this great discussion and for your insight.
Yes, and likewise.
And to everybody here at the Sirius Report Plus community, the Sirius Report community, thank you for all of your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it might be important to. And until the next time we get together, have a great day.